Okay, moving on to your book now, just released on the 11th of October. Congratulations. Your new book, it's called
Thank you.
Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. It's a very strong title, and I'll let you explain and summarize your book for us. But I just want to start by reading a paragraph from the introduction here that I think summarizes your thesis quite well. You wrote that there have been two major financial crises since the dawn of the 21st century, the Great Recession of 2008 and the pandemic of 2020. But there has been only one response from the most powerful governments, institutions, central banks, and political leaders. Their collective reactions have fostered a desolate landscape of frenetic economic consequences. What that produced is a wave of intensified and widespread social unrest, disjointed political upheaval, dangerous extremism, punishing trade wars, and sweeping isolationism. That's a lot of calamities you've listed in one sentence that you've attributed to the actions of the most powerful institutions in the world. Can you expand on that? What exactly have they done to make our society this much more dangerous?
Well, what they have done is created this vast amount of money that the story, their narrative is supposed to help the real economy, but has in fact destabilize the real economy by flowing into the financial markets and through the leverage of the largest financial players, companies and leaders. And so what we've had is not just your sort of regular detachment and regular inequality. We've had this external source, which are the central banks, come in and sort of flow money into the system from the high level that hasn't made its way throughout. And I have a lot of graphs and stats in the book to sort of, pictorially see this, but effectively markets have risen by much more than the global economy or individual countries have grown. And more in an accelerated fashion, and that's even taking into account the uncertainty of this current period. They just outperform the real economy. Mm-hmm. And by having more of that injection of money from central banks, and having no sort of cap on that when central banks deem it necessary, we've sort of demoored the systemic nature of financial markets relative to being, capital raising markets for the real economy. That's all detached because they don't need the capital from the real economy if they can get it and have gotten it from this external source to the extent that they have.
Help us understand, from somebody who may not have a PhD in economics like yourself, why more money in the system may not be a good thing. I mean, everyone wants more money, right? I'm just going to read another paragraph from this book here. Maybe you can elaborate. Whether it was done to soothe a stock market crash, a ruptured subprime housing market bubble, or a pandemic, the Fed's response to the financial crisis of 2008 and later crises has confirmed that it will always seek to grease the wheels of capitalism for its wealthiest participants in private banks. So you're saying that Fed actions have exacerbated inequality, but why is it that the middle class and I guess the poorer among us haven't really benefited from Fed actions?
Well, there's a lot of reasons. One is that Fed actions or central bank actions that go into the financial system without sort of rules attached to them, i.e. accessibility to low-cost money, money that's used to take debt off of your books, whether that be in treasury government bonds, whether it be mortgage bonds or other types of things, isn't something that the regular person on the street can be like, hey, I got these old bikes in my attic with no tires on. Can you give me some money for them? And I'll just put them on your, in your Fed attic. I mean, that it doesn't work the same way with the rest of the economy. This is money that has gone and been leveraged into financial markets versus the real economy. And as a result, the financial markets haven't had to act as sort of capital raising entities by as much to help the real economy, whether that be in terms of lending to small businesses, having sustained long-term strategy for infrastructure development like we don't have in the United States, and other avenues where you could see like long-term economic effects versus a very easy route to making more money on your money, which is basically the financial markets. It doesn't take a long time if you're in the right direction to make money. And it's not that difficult in the wrong direction. Markets are going down as a hedge fund or a trading desk, as we've seen recently with results on Wall Street, to make money on the downside. But real people don't have that relationship to markets anyway. And so when markets have the ability to access more money and people don't, it creates more and more of an effect. And what we have seen, we saw this in 2019, it was the year of the most social unrest through the developed and developed countries on record. And then, of course, we had a pandemic, which tamed some stuff, and we're seeing that come back up again. We are seeing a lot of political unrest. We're just talking about the UK going through like a bunch of prime ministers in a very short period of time. Yes, that's an internal party thing, but it's also the fact that there's no real mandate from governments to people that people feel they can really sort of trust in. So in general, it's not so much that money into the markets is the issue. It's the availability of so much money so acutely, so cheaply that doesn't go into the real economy in the same way that is the issue. And that's where I think there's a permanent distortion, a permanent disconnect between the two.
You talked about the downsides of the stimulus check in your book. You've written, for example, every worker who relied on a paycheck needed a functioning economy in order to be able to put food on the table. So let's address that. I mean, you were saying that the average person doesn't benefit from quantitative easing or perhaps money printing. Well, the counter argument to that is, Nomi, is that millions of people did get a stimulus check. That was real money on the table, was it not?
There are two different things going on. The stimulus checks did come from the government budget, and some of the additional borrowing the government had to do in terms of issuing new treasury bonds to pay for those stimulus checks were also purchased by the Fed. But the amount that was given to the real economy through government stimulus, the amount of bonds that were issued after that fact that were bought by the Fed was a ratio of about 1 to 4. So in other words, the Fed created 4 times as much money as actually went out. And that money didn't, therefore, by definition, go out to the real economy, whether it was to small businesses through PPP loans, and again, they were mostly loans, or to individuals in terms of stimulus checks, which were coming from a different side. The same thing played out in Europe. The same thing played out in the UK in different ways because of different prices and just general economic structures. But this is something that happened, and so yes, on the one hand, money from the government did help people when they couldn't work because everything was shut down through not their own fault, right? But on the other hand, the ratio again. Still very much favored the money that was manufactured. That's still sitting on the Fed's book. I mean, the fact that the Fed's not gone much down from its $9 trillion book size, which more than doubled in the wake of the pandemic, whereas all those stimulus checks have stopped. There is again that disconnect in terms of keeping that money available to support the financial system and the markets. I mean, and this is just the world that we are in.
You've summarized that quite well in your book. You've written that you wrote that $454 billion of the stimulus package was used as money to seed the Fed's lending program. And then later on in the paragraph, you wrote that in practice, these fiscal stimulus packages, though necessary for ordinary citizens and small businesses, were, once you added in the Fed's might, skewed towards helping Wall Street, big corporations, and the markets. So a little bit of a problem there once you look at it from a bigger picture perspective. Nomi, but let's just back up for a minute here. What is wrong with helping Wall Street and the bigger corporations and large government entities? I mean, these are necessary entities to grease the wheel of society and the economy. As you know, you've worked at Bear Stearns and Lehman and Goldman Sachs, right? I mean, you of all people know the necessity of some of the services that these institutions provide. Why is it bad that these institutions benefited?
So again, it's not bad that they benefited. What is bad to characterize it as that is the magnitude at which they benefit without as much of a responsibility to on lending or on moving that economy into money into the economy relative to real people. The reality is, yes, banks do. They do have lending functions. They do have savings functions for people. There's a large gap between the two, even with rates going up in terms of what banks charge. And it sort of is that people at the lower end for low personal loans, smaller businesses get charged way more. And this was happening into the pandemic as well than the larger corporations do. So what it is, it's the unfairness of the relationship between where money is going and the accountability of that money to the top relative to the bottom. Not that the money is there, but how it effectively gets, sort of utilized by those two factions.
Okay. So if you can just, looking forward, project what life is going to be like for the ordinary citizen post-pandemic? I mean, the title of your book is Permanent Distortion, so presumably some things are irreversibly damaged. What is life going to be like now that we've had all these problems that you've outlined? How will the ordinary American live differently now than pre-pandemic, before we had unlimited quantitative easing?
Right. Well, I think again we still might get quantitative easing back, and this didn't impact the real person. But I do think we're in for a period, the real economy, real people are in for a period of sort of heightened inflation on prices, from what we pay at the pump, to our electricity bills, to our food bills, to fertilizing that food, which also feeds into our food bills, to health costs, to transportation costs, to rent. I mean, we are in a period right now. As to an extent, partly because of supply chains, partly because of the result of this leverage that came into the market in such an excessive way 2 years ago and went to the top of the market and to top of real estate. We basically created this elastic band between the real economy and the sort of financial economy to begin with. And now some of that's being dialed back, but it's hurting the real economy. I think we are in for, very choppy times from the standpoint of the real economy. We are in real, and we're looking at real price inflation that's not going to go back down to 0 to 2% for the next year or 2 or 3 at least.
Now, you did say, you said that earlier in the interview as well, we're not going to go back down to 2% for the foreseeable future. If I were to ask you, Nomi, if you had a magic wand and you were to reverse engineer 2% inflation by 2024, what would need to happen in the economy?
Well, again, I think we need to grow, for example, the types of energy uses that can meet the more expensive sort of geopolitical energy situation, from natural gas to oil, to different types. Some of that has to do with releasing reserves. Some of that's more of a government decision. Some of that has to do with building and expanding other sources and the technologies to make those sources cheaper for people. Because again, fuel is a big part of all of our lives. Whether we think the fact that we're having this conversation is related to fuel. So I mean, there is a tremendous impact on the economy, and I think ultimately that's why shifting that. The new energy, the energy transition, even making other forms of current energy that we're using cheaper, more accessible, more available. I think that will go a long way to reducing inflation. And I think that will feed into food inflation and other types of supply chain, commodity related, energy related inflation. And I think that's going to be a big thing. I don't necessarily see rents coming down, except for people just not being able to pay them, which is an unfortunate thing. I do see the potential for rising, which we're already seeing actually in the data right now, rising home foreclosures or delinquencies or defaults in mortgages. So I see sort of more destability in that market again, not to the extent we had in 2007, 2008, because it's not as leveraged, but certainly I do see wobbling as well there.
Okay. Looking ahead now, you've outlined several transformative shifts in our society from a technological and financial side. This one paragraph from a later part of your book: we are embarking on a transformative era, just as fire, the wheel, the Industrial Revolution, and technology spurred radical transformations in the past. Permanent distortion means there is no going back to how things were. In its wake, sectors attracting public-private infrastructure investment in the real economy can still emerge as a force for future stability and positive change. So can fields concentrated on sustainable power, technological innovation, virtual collaboration, portals, and the revolutionizing of money itself. Okay, so you've highlighted several factors of society that's going to be transformed forever. What technologies do you think will benefit the most in terms of advancement in the coming decades?
Well, again, as we talked a little bit about energy, but I think decarbonization types of technologies will be at the sort of center of that energy transformation. That also includes storage technologies, battery storage, sustainable battery storage. So we also can actually reserve energy in a way that we still need to do by more of. I mean, one of the reasons that we're facing an energy crisis, aside from geopolitics, is we weren't able to store enough to begin with. That's not for individuals, that's for corporations. So I think those were going to be where the technology side and the energy side are going to commingle. I talked about other transformative technologies there. I think there's, and we start to see this with crypto technology and Bitcoin and everything else. I do think that the definance or this ability, because of everything we're talking about banks and their availability for getting cheap money versus other sort of decentralized financial institutions. I do see there being more B2B, P2P type of lending and different kinds of decentralized finance happening outside of the main financial system. This is already occurring. And obviously, when we have these sort of risk-off scenarios like right now with more market uncertainty, that they take a little bit of a slowing down period. But I do think that trend is there, and I think it's going to continue as we see the second stage of the Fed pivot to effectively, allowing more investment outside of the financial industry. That also includes investment commodities that are representatives that have both use values. For example, like silver, which has use value and it's come off a lot this year for different reasons, including the dollar being strong to gold being stronger than silver, and so forth. But we do see silver and copper as being also intrinsic to feeding that whole sort of space of sort of money outside the system in a different form, but also usable metals for the transformation from an energy perspective. So I talk about this in the last chapter of my book, but there's a lot of transformation that we're in the middle of right now. That is going to be happening not just next year and the year after, but be over a decade or so to come. It's going to be a very exciting time.
Very exciting indeed. And I'll finish up on CBDCs, Central Bank Digital Currencies, which is a chapter you've talked about in your book extensively. Several countries are working on CBDCs. So a central bank digital currency on a high level is simply a digital token issued by the country's central bank, which usually is pegged or is planned to be pegged to the country's fiat currency. The U.S. Federal Reserve is slated to be thinking about working on a central bank digital currency. Here in Canada, where I live, the Bank of Canada is already working on one. The Bank of England as well, the Chinese central bank, so on and so forth. So it's happening all around the world. The Israeli central bank, for example. How is CBDCs or how are CBDCs going to change the every man's life? Like the everyday person goes into a store, buys something. Does he care about CBDCs?
So I think what's going to happen, and this is going to be over multi-years, as you said, all the central banks are working on this in different stages. I think the advent of Bitcoin and cryptography, as it was cryptocurrency, as it was more recently since the financial crisis, has given them sort of more fuel to that fire. They want to be in control of any kind of currency out there, and so they're speeded up their research and their potential issuance of CBDCs. But as you also said, and as is the case, they're going to be linked to fiat currency. So in a way, it'll do two things. It'll give the Federal Reserve and other central banks just another easier avenue towards creating money when they need to. It's pretty much digital anyway, but this will be sort of a digital format where there's also information within that digital currency as well as the connection to fiat. And what that can also mean is as and if people ultimately transfer their accounts from the larger commercial banks into some sort of we're years from this, into some sort of central bank related sort of banking account or sort of middle account between the Fed and say commercial banks or larger commercial banks. They will potentially see more, just the information being sort of captured from that scenario. That said, the government is already capturing a lot of information that people have in terms of their transactions with the commercial banks. So there might not be a tremendous day-to-day change on that, but there certainly is more information in the types of technology that will back a CBDC than potentially there's available right now in just digital transactions with regular banks right now. But again, I think this is happening over multiple years. It's not like tomorrow all of a sudden everybody's going to have their bank accounts sort of restructured into something else, because don't forget, Wall Street really kind of wants to keep control over their customers as much as the Fed wants to keep control of creating money, and Wall Street wants the Fed to create money. So all of this is going to be, I think, a very slow process, but it is in retaliation or fighting other types of cryptocurrency usages that can happen outside of the main systems, and that's why that's why all the central banks are sort of trying to get there as well.
So final question, I'll wrap up and I'll let you go. The CBDCs, there's wholesale and there's retail CBDCs. The retail side is what I'm curious about because I'm not a financial institution. I'm an individual. As an individual, Nomi, I'm concerned about whether or not the government is going to issue CBDCs for everybody. Am I going to be paid my salary? Am I going to be paid in a digital token that the government can track and monitor? Is that what's going to happen?
Again, I think if that does happen, we are years from that. I think it's more likely that where you keep your money, you get paid as you get paid, which is probably electronically. You're probably not being given out, sort of bills in physical currency. None of us are, right? It's
Sure,
all,
yeah.
that mechanism is going to stay the same, but that mechanism might be backed by CBDC currency from this perspective of your bank account and your bank's relationship to your central bank. So I think that's really the first stage. I don't think any government's going to come in and say, okay, all of a sudden we're basically going to transfer all of your funds from whatever bank you're in and whatever multiple bank accounts you may have into a central bank, because again, there's a lot of there's a lot of chains between the central bank, the bank, and the government that need to sort of be sort of preserved as they are along this period. I think more likely you're going to be given the option.
Right.
Yes, if you do use CBDC, they will be more trackable in terms of information,
Sure.
sort of granulars. But at the same time, again, the government, or at least in the United States, government can go into anybody's account on a regular commercial bank and sort of garnish their money to pay back taxes if they feel like it. So I mean, there's going to be more information passed along.
Somebody listening to this right now who might not have a deep understanding of digital currencies might ask you, Nomi, well, why is the government even looking into this? Why is this necessary? Like you pointed out, my salary is being paid digitally anyway. No one's giving me physical cash such that I have to go to the bank myself physically and deposit it. Everything's digitized anyway. I go to the grocery store, I tap my phone. Why is this a necessary technology, Nomi?
Well, again, it's a technology that helps if the government wants to know that extra information. Ultimately, and it's limited. It does
so it
help
helps
to
the
keep
government. It doesn't help me.
It doesn't necessarily help you. It really doesn't. It's just because from your perspective, what's going on between what the government currently knows about you, what your bank currently knows about you, how your transactions are already transparent, regardless of whether they're in a blockchain behind a CBDC of a central bank or not. That's still kind of hovering around us as people nowadays. This is just one more mechanism whereby more information can potentially be captured, where the central banks can potentially create more money in different formats, where they can potentially compete with other forms of cryptocurrency that might be used outside of the system. So in a way, this is about information. It's also about getting in front of the potential loss of control.
Is this something that I can willingly opt out of, Nomi? Can I say to my employer, can you not pay me in any government-backed CBDC or blockchain-based currency? Is that something possible down the line?
I mean, I think this is potentially an evolution of years, and there'll be many steps along the way. And I think along the way, you won't have to have I don't think there's going to be a forced conversion. I think if anything, it's going to be something that's sort of put out in little mini dosages and for years to come.
All right. Well, Nomi, I appreciate your time. Excellent read. I encourage everybody to check it out. Permanent Distortions is out on ebook stores everywhere. Thank you very much, Nomi, for coming on the show, and thank you for spending time with us.
Thank you so much, David.
And thank you for watching Kitco News. I'm David Lin. Stay tuned.